in the group. We're just going to go with Kenny tonight and listen to his chat and ask some questions, and then we'll catch up with whatever other agenda items we have for the next meeting, and maybe talk about some sponsor calls that we've all been doing, and then the spreadsheets that I sent around. I think it'd be nice to have a little bit of chat about how those look and how those work, and hopefully by the next time we talk, we'll be done with the deal analysis part of it too, because we're also coming up with kind of some metrics for that. And I'll send around an email to figure out when we want to meet next, and see if people are still into the regular meetings, since things are opening up a little bit. I'm not sure if we're quite ready to have a big dinner together, maybe a couple more Zoom meetings. But with that, I'll turn it over to Mike, and you can make introductions, and then we'll have Kenny Wolfe speak.
Yeah, thanks, Kenny, for allowing our group, who I think you offered to provide a little talk to our group, and I think we're largely kind of like wealth education addicts, so don't turn that opportunity down, that's for sure.
Awesome.
And I thought it was interesting. I'm kind of getting new into looking into some syndication and investing, and I think that, I share probably that experience with maybe a third of the group or so. But whenever we had a chance to talk, you've had some deals go full cycle. You also take a little bit different model than some of the other sponsors I've talked to, where you're, you are starting to vertically integrate a little bit with some of your property management.
Right.
So,
Yeah.
so you'll talk a little bit about that, I'm sure. Or maybe the guys will have some questions. But with that, again, just appreciate you taking some time, and probably a decent amount of experience in the group in different areas of investing, but some newbies and some experience. So yeah, thanks again.
Yeah, no problem. Thanks for having me, guys. I appreciate it. Always like to talk to new folks. So, so Jim and Mike, am I able to share my screen for a quick presentation there? Maybe not. If not, I don't have to use it.
You should be able to. I think Jim might just need to select.
Hey, Jim, you're on mute.
Jim, you're muted. Yeah.
Sorry. Yeah, this is not my first Zoom call, but it feels like it. I got to figure out how to unlock the share screen.
And if you go under share screen, there's an arrow in the top right corner of the button.
Yeah.
There you go. I got it. Yeah.
You got it?
Yeah.
Okay.
Perfect.
Excellent. I'm going to mute myself again so I don't.
There you go. Okay. All right, guys. So yeah, this is just a quick presentation that we I go through, but there's two case studies here at the end that we kind of go through. But first, I get a little bit about us, just to kind of let you know who we are. So we're Wolfe Investments. I started this company almost 10 years ago, investing in multifamily assets there in Dallas, Fort Worth, Texas area. So we're a fully integrated private equity real estate firm. It's a really big, that's a really long phrase there, but like Mike said, we started to kind of vertically integrate our business here. Up until about 2 years ago, I had used third-party management on all of our assets. I got frustrated, so I bought one. I figured it was a lot better than building one from ground up. So I bought into an existing one. We've teamed up. Right now, they run all of our Texas, Oklahoma, and Louisiana assets, multifamily assets. And then we're actually about to buy a Dayton, Ohio-based property management company that'll basically get our management company as a whole to managing about 11,000, 12,000 units. And so that'll bring everything in-house. You don't really buy those for the glamour of property management. There's really not much of glamour in that business. It makes a little bit of money, but really the bigger kind of picture was to get more control of our management and build a better mousetrap. It's kind of what we were going for there. And obviously private equity, we syndicate all of our deals from our investor base, those in our investor database. And I think we're pushing over, we're about 1,100 folks on that database by now. So keeps on growing. We definitely do multifamily. That's where we started out about 10 years ago. This presentation is mostly multifamily based. But we also branched out about 2 years ago into buying triple net and double net assets. So we own 14 dollar stores from Texas to Georgia underneath a fund, 2 funds actually, and then we just closed out our second fund. And then we also are starting our second ground up development, building 88 multifamily units in Dallas, Fort Worth, Texas, right now as well. So, with this group being mostly multifamily based, I figured I should just cover that. But I also want to mention the other options that we offer up there at Wolfe Investments. So anyways, probably preaching to the choir, but multifamily real estate, existing multifamily real estate has been really great for us. You guys all probably know these points, so I'll cover them quickly, but demand should only grow over time. Obviously, there's more and more, middle class folks being created every day. And so that means they're not building any more 70s, 80s, 90s product anymore. So we're having more fish in a shrinking fishbowl is how I kind of tell folks. So because of the ever growing increased demand, we should see our values just get pushed over time, over the long run. Again, yes, B and C class, supply is stagnant. You can't build a B and C class. So anyways, and some options we're seeing those being bought and torn down to build A class. So worst case, we've got a steady supply of B and C growing demand. Obviously, loan options are abundant. Most of our loans are non-recourse loans. So Fannie Mae, Freddie Mac. We just did our first HUD loan assumption. That took all but 7-8 months to finish, which is what they told me, but I didn't believe them. But now I do on that. So the HUD loan assumption was very interesting to do. Great loan on that new asset we just bought. Obviously, we're looking for, we call it the 4 wealth building pillars or building blocks there at Wolfe, but the cash flow, principal pay down, appreciation, and the tax shield are the 4 things that really make multifamily kind of stand out from our other, other real estate classes. Although, like I said, our double net, triple net, those are mostly for cash flow. And then obviously ground up is going to be pretty much all our appreciation. So they have their perks too, but multifamily you get all 4 of those there. And then obviously the big deal for bigger multifamily is that the valuation is based off your net operating income. So you're much more in control over your value. Obviously, if you can push revenue and make expenses more efficient, you're gonna be able to drive your NOI and be kind of in the driver's seat on your valuation of your asset. And we'll go over some of those examples here in a little bit as we go. So again, kind of a little bit about us. Started in 2010. Very good time to start in real estate, obviously. So it was great timing. We're actually closer to over 250 million in transactions to date. It's 4,200 units, so it's a little different, a little off key. But and then we've been in 5 different states. So currently we own in multifamily in Texas, Oklahoma, Louisiana, and Ohio. And then we're in multiple markets in Texas and Ohio. As that we've got in-house management, like I said, about to add an Ohio management company underneath the umbrella. And then so far we've been voted in to save 3 multifamily deals. So we weren't the original deal sponsor on those 3 deals. They were failing. 2 of them were from the same deal sponsor out of one of the guru groups. So I'm no longer on his Christmas card list. But they voted him out, voted me in. The first one was a hostile takeover. The second one from him was just hand over the keys and he was okay. But anyway, so we've been voted in 3 times to save some multifamily deals. All those were in Dallas, Fort Worth. Which in Dallas, Fort Worth, you've got to do a lot of things wrong to have a failing multifamily asset, as it's just kind of gangbusters on rent up there. You have to be really bad at what you do to go wrong there. So anyways, we turned those around. One of them, we ended up doubling the investors' money in 4 years on one of those saves. And the other one, they were lucky to make 20% over the 20 months that they owned it. And then, so we saved that deal. That one was pretty hairy. And then the third one we actually still own today. It's a cash flowing asset in Oklahoma. So everybody's happy with it, and just to keep it and, keep printing money on that one, on those 3. And these are pictures of some of our assets right here. So this is our Montana agave asset in El Paso, Texas. Beautiful blue skies out there. If you ever get a hike out there, I recommend it. Here's some other ones. So this top left one here, that's Parkview Apartments in Columbus, Ohio. Go drive by that one. It's at 1500 Diamond Lock out there in Columbus. So beautiful property, got ponds on it. Our pool is marked on Apple Maps, so it must be a really cool hangout spot. But anyways, so that's one of our most photogenic ones there. Bottom left there, that's a second asset we bought in El Paso. It's 309 units, massive pool. I mean, that probably doesn't give it scale enough, but it's just a huge pool out there. We've got about 500 units in El Paso now. And then this one to the right, we bought 403 units in Shreveport, Louisiana. We paid $16.5 million about a little over a year ago, and the seller paid $21 million back in 2010. So he took a haircut to give us the opportunity to turn this one around. So it's been a big lift. It's 27 acres of land and 403 units. Is a massive rehab deal, but we've got that done now and are back in lease up mode right now. So we're back to, we had to get that down to 37% occupancy, which is kind of scary on 403 units because obviously simple math, every 10 points is 40 net leases you have to make. So anyways, we're back to 60% as of, I think, today on that asset. So that's turned around really well for us. Again, so I threw Parkview in here. So it was a great property. We bought it for $65 a door back in 2015. I feel like that was the last good deal in Columbus, and I joke because we bought one last year in October, but anyways, up there, but 65 a door for something built in 2000 is just unreal today. So it was really good timing. None of the interiors had been touched since 2000. So it was the linoleum square tile flooring and all that kind of jazz, kind of just, 2000 finish out. So we went in with a upgrade unit, interior upgrade unit package there. We've done 92 to date on that property. And those are still flying off the shelf. We get about $100 rent bump on those upgrades between the classic units and our upgrades. So originally NOI was $1,025,000. We raised just under $3.7 million to buy it. Current NOI is 1.296, and actually is really good timing. I had a BOV done recently, just 3 days ago. On Friday they presented it, but now they're valuing it at $22 million. So we bought it at 13.75 worth 22. So again, we raised 3.7. The equity gain is 7.4 million on that, and then with our cash flow and everything in there to date, we also did a refinance, a supplemental loan on this to pull some cash out. So if you include our cash flow, the principal or the supplemental loan that proceeds back to investors, and then the equity gain, we're sitting about 180% return. So if you put in 100K, it's worth 280 today, basically through cash flow and appreciation and all that. So really great deal. We do have a massive prepayment penalty on this. So we're kind of stuck for another 3 years owning this thing because the prepayment's about $2.5 million. So that would eat up a lot of that gain. So anyways, we'll wait on that one. It's doing well for us. And then this one we sold recently in Denton in January, and I'm glad because they've had 2 fires since on this property. So I'm glad we got rid of it, but it was a big deal. We bought it for $34 a door. It was a D class. I mean, just to be honest, everybody, no one says they buy a D class, but this definitely was a D class. When we were doing our unit by unit walk, there was a 3-bedroom there, and we counted 16 mattresses lined up against the wall on a 3-bedroom. So that's who was living here. There are a lot of holes in the walls from fists and that kind of stuff. So we bought it really cheap. This is the only deal I've bought off LoopNet ever. So I always joke that LoopNet is where deals go to die. Well, I'm one of those guys who broke the rules. So anyways, we bought this deal for $34 a door, and we sold it for $92 a door. So it's about a 300% gain for the investors. Big value add deal. I think we've replaced every piece of underground pipe on the property, built in 1968. It's probably a C+ class now. That's about as far as we could take it for that part of Denton, Texas. But we did make big improvements, really made a better community for the long-term residents as well. We were thanked by the Denton Police Department a couple times for cleaning it up. And then right around here, there's some single family that's pretty nice, and they also thanked us a few times for cleaning that one up. So, and those are the 2 case studies. I've got a lot more, but those are the one. I kind of make it pretty kind of quick to go through because leave more time for Q&A. So if you guys got questions or want to talk about whatever, let me know.
Awesome. Hey, I do have a question. So you said you're doing your own property management now. You bought a company. Does that change how you view the exits on these deals? Because I'm in a bunch of deals with another syndicator, and they're just starting their own property management. But one of the things that their model is basically they're flipping multifamily, right? They're trying to get out of them in 18 months or 2 or 3 years. And so my thought was, well, if you're starting property management, you're not going to want to sell your assets as quickly, because then you're kind of cannibalizing your own business. So I was curious how you look at that.
Yeah, sure. So we've always been a long-term hold on real estate, even before we owned our own management. I think it's a much better way to go because we have that refinance option or the supplemental loan option. So our business plan is to hold these assets long-term, and then do some kind of capital event in year 2 or 3 where we pull out between 30 and 60% of the initial equity out of the deal back to investors. It's a tax-free event. They get their money back, that portion back. They can reinvest it with us or whoever they want to, or we'll buy a Tesla, whatever they want to do with it. But that way we're enjoying that tax shield. So if you're flipping these multifamily assets, to me, you're missing out big time on that tax shield. So we've that's kind of why what we've done from the get-go is hold these 5 to 7 years. That's always kind of what we tell our folks.
Okay. And so the property management, then you're still, I mean, if you sell a 400 unit building, are you thinking that you would maintain property management with the new owner, or are you going to have to then, how does that work? Because aren't you losing some business when you sell, or you're going to have to get rid of some employees, or?
Yeah, but that's a whole different thing, right? So that company grows itself through third-party management. So I'm not too worried about that on the growth side. I don't worry about that. Between now when this other company comes on, we'll have about 11, 12,000 units. So, it's not going to hurt us too bad if we lose a 400 unit because we're also adding, we're adding, there's a group out of California that owns 2,000 units in Dallas-Fort Worth, and they want us to take over management,
Okay. So you're going to do other people's, you're not just managing your own units, you're managing other units as well.
Absolutely. Yeah. So it's its own kind of standalone company. There's a president that runs it. I still don't know how to evict anybody. I let them do that. So I don't want to know how to do that. Okay. I don't hold the keys to anything. They do all the operations. So they're just run as 2 separate companies.
Okay. So that could actually lead to opportunities. If you're managing other people's properties, you might be in a position to buy some of those if they came up for sale and you'd already know something about them.
Yeah, I mean, to me, the bigger deal is that so we have a master insurance policy right now through Allied. That's the management company that we own right now, and we get pretty big discounts to not just our investors, but whoever else we manage, and they use our master policy, they get big insurance discounts. But once we buy this Ohio management company, then we're going to be big enough to go directly to Lloyd's of London, these other insurers directly, and not mess with the mortgage broker. So our insurance broker. So our cost, not just to us, but our third-party folks, is going to go way down on insurance. So there's ways also to kind of vertically integrate that as well. So to me, that's the bigger benefit, is being able to really scale it up and bring more value to not just us, our investors, but everybody that uses us.
Cool.
Hey, Kenny, I got a question for you. So looking at, receiving a decent amount of deals in my inbox right now, and I noticed some I'll get from the same deal from maybe 2 different sponsors. So for example, your Rockefeller deal, I got the same one from Lane.
Yeah.
And from being newer to how the partners work, how do you guys work that out? Like, is this something you could share with us? Some of the different structures that you see? Yeah,
sure. So we've teamed up with Lane. I think this is our 3rd or 4th time. We typically don't do that unless it's just a massive equity raise, like the Rockefeller. That's a big raise. But so typically we don't partner on that unless we just need extra equity from our group. We can usually raise $5 to $6 million pretty easy on a deal within Wolfe Investments and investors. But if it's above that, or if we have multiple deals going on at the same time, that pushes over that 5 to 6 million comfort, we'll go out and get find some equity guys like Lane to help us out on that.
Good.
And what does Lane do? Is that how he does all of his stuff, as partners with people, or does he do his own deals?
So Lane was smart, quit his corporate America job, moved to Hawaii, and so he's a civil engineer out there for the state of Hawaii. I think just for, I don't know why he still does that, but he's got a big podcast. He's got a big following online, but basically what his model is to be the equity plug for other deal sponsors that he knows,
I see.
And trust and all that kind of stuff.
Okay.
So he's a smart guy. He gets to do all the upfront legwork and then just hang out in Hawaii. So
not a bad deal.
Good for him.
Yeah.
So.
Are there other questions? I have a few questions, but I don't want to monopolize it. So if anyone else has questions, jump in. But while we're waiting, so I don't know if this is a too technical of a question or not, and maybe I don't fully understand it. But so I read a couple of books, and they talk about economic vacancy and how that includes things like bad debt and some loss to lease and some of the other things. And both of the places I was reading and people I talked to said, if you see a deal that's 5% vacancy and they don't have any of the other metrics built in, and their economic vacancy they're underwriting to 5%, then they're missing. It should be 8 to 13%. So I guess my question is, do you agree with that? And whether you do or not, are there any metrics like that where you can, from our perspective, a passive investor, if you can look at a deal and say, there's these 3, 4, whatever number of things that if those aren't what they should be, run from that deal?
Right. Absolutely. So yeah, I think the vacancy is a big deal, but if someone's trying to cheat on so there's 3 places where I see deal sponsors cheat. The biggest one is on the reversion cap rate. So if you so there's a group that was buying a deal in North Carolina. I won't say who they are, but they assumed that they were going to buy this B asset for a 6 cap, and this was maybe 2 years ago. They were going to sell it in 5 years for a 5.5 cap, and it's a B class asset that's mostly fixed up. So if you do the math, and the biggest way you can move the projected returns is you subtract a quarter or even a half point to that reversion cap rate, and that's going to make a mediocre deal look like it's going to sing and dance for you, right? So that's the biggest one.
Can you explain that? Because I've heard that before. Like typically and I think reversion cap rate, you mean the cap rate that you sell at, or the pro forma sales cap rate.
Right.
Just so I'm getting the terms right. So what I've heard is generally you should sell at a half point or 50 basis points above what you bought at.
And these are all kind of, yeah, I mean, that's all gross generalization. So I think it depends, where you are at in the world. If you're we're buying an asset in Oklahoma, we have to put on our Oklahoma hat, right? So, we assume either an 8 or 8.5 cap rate on our C class stuff there. If it's a B, maybe 7, 7.5, depending on where it is in town. So I think it matters if you're buying an A class deal, your cap rate's really not going to change all that much over the next 5 years, in my opinion, because interest rates should stay pretty low. So it kind of depends on the asset and kind of where you're buying. But I agree with you. I don't think you should put it lower than what you bought it for sure. I think if you're in the normal kind of B and C class space, I would add maybe half a point to it just to be on the conservative side.
Can you expand on that with the math of it? Maybe I guess I still am not. I hope maybe this is a dumb question, but I'm still not 100% sure I understand why you should not pro forma the cap rate lower on sale.
Okay, so hold on. So let's back up.
Yeah.
So each deal is going to be very different, right? So if
Right.
you're buying it for this massive value add deal, then you may have a cap rate that's lower. If you're doing all this value add component and you turn it from a D class to a C class or even a B, you're going to go from hopefully buying it from an 8 to 10 cap to selling it for a 6 cap, right? But that's one business model. But if you're buying it just for cash flow and you're not banking on appreciation, like here in Cleveland, you know, when we underwrite these deals, we definitely don't lower the cap rate. We just keep it the same, or even had a half point on the B and C stuff, because we don't see it moving all that much. But you know, but up here we're buying for cash flow. We're not buying for appreciation in Cleveland, not yet. I think it's going to come, but we're not banking on that. But in Dallas Fort Worth, if you're buying, it just depends on where you're at in the world, I guess, on the reversion cap rate.
Okay.
But that's where I see people cheat the most, I guess, is what I'm trying to warn everybody
The
about.
market sort of dictates the cap rate itself to some extent.
Yeah, absolutely. But you can get that. So how I did it, you know, I would say, before buying a deal in Columbus, I had never been to Columbus. You know, I found Columbus through the Berkadia puts out an annual report with all the major markets in the U.S., kind of what they did on the multifamily side. It comes out in January. I look forward to it every year. But so if you don't look it up, it's a great thing. But it talks about, in that, it was about, I guess, 6 years ago, it talked about how Columbus was the only major market where the price per unit was still lower than the 2007 price per unit. So, and it was a growing city, right? So I saw that, you know, I called a cousin who knew a guy kind of deal in property management in Columbus, flew up, you know, that next week, you know, met with him, met with the property management company, talked to 2 others, but I liked him better. And then the next day drove around to visit their properties unannounced. And I picked ones around the city so I could learn it pretty quick mostly of where not to buy. Because sitting in Dallas Fort Worth, I can't look at every deal, but I know if I can mark out of a whole section of a city, then that makes my life a lot easier. So that's kind of how but also what I did on that to learn about Columbus, Ohio, was I called up the CBRE appraiser, the multifamily appraiser. And they apparently don't let those guys out of the office or talk to very many people, because if you call them, it'll be an hour-and-a-half conversation about cap rates. And so I think they're lonely guys. But anyways, we talked about an hour and a half, and, you know, I asked them, okay, what were cap rates in 2008? Were the worst of it. What are cap rates today? And where do you think cap rates are going to go, you know, 2 years from now? So kind of give a feel of what that local cap rate looks like. And the best place to go is the CBRE guys. They do most of the appraisals. You know, they're usually the bigger group that does appraisals in the major metros. So that's kind of a way to learn that cap rate.
Okay.
And the other place would be expenses. You know, folks a lot of times underestimate property taxes, especially in Ohio. They're big up here, just like Texas. And then also too, like, what can you really run it at? I mean, I've seen, you know, payroll projected at 800 per unit per year, which is way too low. It's, you know, no matter across our portfolio, the average is 1,100, maybe 1,200 dollars per unit per year on payroll. So there's things to watch out for on that as well. Make sure they have the insurance right. So property taxes, insurance, and payroll are your big 3 expenses line items on any multifamily asset. Unless you're owning stuff in Oklahoma and Colorado where there's very low property taxes. That's going to change that somewhat. But if you're in Ohio, you focus on Ohio, property taxes, same in Texas, are usually number 2 or number 3 on you know, percentage of your expenses. So make sure they have that right. And then the third one is the revenue. You know, what rents can they actually get?
Hey, Kenny.
Yeah.
How many multifamily deals have gone full cycle for you? And can you tell us the average annualized return, or IRR?
Yeah. So we've sold, I got to do a little mental math, because we sold one in January and sold one 2 weeks ago, 3 weeks ago. Anyways, we sold a small one, but we've sold 8 so far, full cycle. But what's funny though, is our first syndication deal, we've refinanced that 3 times now. So the ones we like, we keep. So that one we've pulled out, that first one, we've pulled out 386% to investors so far on their money. And the reason why I like to do that is because we still haven't paid taxes on that money. You know, we've owned it almost 8 years now. It's just a cool little deal. 76 units. It just prints money. No matter how much debt we put on it, it keeps cash flowing. So anyways, it's a good little deal. But we've done 8 across the portfolio. We've doubled investors' money in 32 months on average. And I freely admit half of that was probably the market, because cap rates went down as when we got started. And I'd say probably the other half is us doing better than what I thought we could do. So I can't take the full credit. That's something else to watch out for a deal sponsor. If they take full credit from a run from 2010 to 2018, don't buy it. Part of that was the market. So anyways, so the average month's 32 months, doubling their money. And Steve, I hate IRR. I know people love it, and I'm one of those that I just don't like it. So I always talk about total return, just because I feel like IRR you can manipulate that formula a little bit. So,
Right.
But anyways, that's a personal issue.
I heard someone else say that too, so that makes sense because you can pull out money early and that make your IRR a lot higher.
Yeah, and you have to assume what somebody else can invest their money at, right? So if I have an investor, like would they put that in a savings account or would they put in another multifamily asset? I mean, I have no idea, right? So but when I calculate my IRR, I have to assume one of those options or somewhere in between, right? So.
Yeah, thanks.
Hey, Kenny, sorry if you answered this earlier. I was jumping in and out, but what was your career like before you started Wolfe Investments in terms of real estate exposure, investing? Were you already working in the industry?
Yeah, that's a good question. So no, I wasn't. I was in oil and gas, as any good Texan should be. Coming out of college, I did accounting for that. And so I was one of those guys, one of the shale guys, I guess. But I was on the accounting side. So, I was pushing paper, but I was CFO at age 28 on a startup company in Shreveport, Louisiana. So that's kind of where we got our seed money. Our sole client was Chesapeake Energy. I think this may be the third time they go bankrupt, either last week or this week. So anyways, our contract with them was before they had their first money issue. So actually we were 3 years into that 5-year contract. My wife and I decided we've got to be in a different industry than oil and gas because it's so up and down. So we jumped in. I called a family friend. She's a trust fund kid. So, I've always said I want to be like her when I grow up. I asked what she invested in, and she actually pointed me to one of the guru groups in Texas, Lifestyles Unlimited. So I'm an alumni from 2 guru groups actually. So Lifestyles Unlimited, they're based in Houston, been around for 30, 40 years. Their own AM radio down there, but and then Sumrock, Brad Sumrock, I was his first student before he even had a group going on. I ended up being his first coach, so I coached a lot of the newbies coming on there. And then I probably broke off from him 4 or 5 years ago now, 5 years ago. So that's kind of how I got into multifamily, but I had never owned any rental real estate before. I invested passively twice. So once in a yield play, once in a value play. And then our third deal was syndicating 76 units. So I managed to skip single family altogether. But mostly because we had that seed money from oil and gas to kind of jump into and throw it all into multifamily.
So Kenny, what would be your ideal multifamily investment? Like what kind of property would be ideal as far as what you're looking for today?
So we do it all really. I mean, we do deep value add stuff and we do cash flow deals. Cash flow deals are a little harder to come by. But the one for example, and we have investors that like both, right? So we've got a massive redevelopment project we're doing the equity raise on now. It's a big time appreciation, not much cash flow for the first 2-3 years. But then today I just bought, we've got a property going to contract up here in Cleveland, 96 units. We're paying $29K a door for this thing. It probably needs maybe $3K a door of deferred maintenance, but the rents are almost $600 a month. So, so for a cash flow deal, this thing's going to just throw off major cash because, our rent to basis ratio is almost 2%. So when you can find a deal, and Cleveland's the only major metro you can find that ratio anymore, by the way. But it's an awesome deal. I think it's 95% occupied right now. So it just depends on. We look at them both, I guess, is the bad answer that I'm going to give you. But we always like to double investors' money in 5 years or less. So as long as it meets that metric, and we're conservative on our underwriting, then we tend to do the deal.
Right. Good. Yeah, that's helpful. And for the renovations, so you're doing those in-house now, whereas before you had like property managers doing that for you. And is that one reason that you're kind of going vertical with your integration?
Partly There's two schools of thought of that in the multifamily world. So one of them, there's GCs that specialize in multifamily construction. And then property management companies typically have their own construction arm. I always went with the property management company, even before we owned our own, because a lot of that construction needs to be communicated to the operation folks. And so if you've got two separate parties doing it, I've seen some miscommunication from some other guys where that happens. So if you've got, if at least they're the same company, you're going to have better communication on that. So that's how I did it. I've got colleagues that always do a third party, outside third party. So kind of depends on which camp you're in on that.
Right. And you're looking at more kind of light value adds if it's 3,000 per door, as opposed to kind of like complete renovations.
We've done both. I mean, we've done both, but yeah, for this specific one, it doesn't need much. It's a C class, it's a C plus deal in a C plus area. So it doesn't need much really. I mean, it's going to be, a little bit of exterior paint to dress it up, make it pop, and then a little bit of landscaping, and then probably upgrade half the unit interiors. So those interiors may cost us $3-4K, but we typically only do half of them. So that way we can capture two markets on the same property, So when, our leasing agents can show, I always have them show the upgrade unit first, to sell the dream. And then and then if they say, no, what's your classic look like? And then she goes, oh, well, this is our classic unit, and show them that, in that tone, So anyways, but you can capture both markets in that same asset. And I've seen guys too over improve, or they go out and do the whole thing. And then there's one, like, if there's a downturn, can you still rent those upgrade units or do you give those away for a discount? And then two, you've got to leave something on the bone for the next buyer as well. So, and then go ahead.
Oh, sorry. Thank you for joining our group and talking to us tonight. This is fantastic. So I really appreciate it.
Yeah.
I was listening to Buck Joffrey's latest podcast this morning while I was walking, and he had Ken McElroy on talking a lot about what they're kind of anticipating coming next with the economy, and expecting the earthquake has happened and the tsunami's on its way, blowing everything up, if you will. Just curious your take on current state and what you think is going to occur over the next couple of years, or whatever that might need to be cautious around.
I think they're wrong. And I say that, so, we've got assets in multiple markets, right? So even in like as early as March, I was saying there's no way this is the next 2008, 2009, because I was looking at our rentals, and our traffic for our leasing was still strong, even though it's all online. So we're still leasing out properties. Not only that, but we were able to raise rents in Columbus, Ohio during the pandemic. And then second, we were able to, they're still leasing our upgrade units just as popular as they were before the pandemic. So with people, and then you've got people paying rent, so our stuff, our A-class stuff is about 95-97% collections of what they were pre-COVID-19. Our C-class is probably the worst one, is at 88%. So people are paying rent, and then if they're not, the lenders are willing to work with you on a forbearance. So back in 2008 and 2009, everybody had a gun on each other and they fired, right? This time, no one's firing. They're all working together, right? So I was actually buying a whole bunch of stock in March because I was seeing this on the multifamily side. I was like, people are paying rent. This is not 2008, 2009. We're not going to have a crash. It's going to be pretty quick. So anyways, I'm glad I did. That was a good thing to do. But I don't see it. I mean, people have to live somewhere. Single family homes, at least in the markets that we're at, they're not going down even in today's economy right now, with people at supposedly a 13%, jobs being missed, or unemployment. So if that's not going down, I mean, that means the mortgage rates are still going to be their mortgage payment's going to be the same, if not going up higher. Give it a year, and then, so I don't know. I don't see this mass exodus out of multifamily. Where are they going to go? I mean, there's no place to go. Interest rates being low, and the Fed said they're going to keep it low for at least in the next 2 years. And and because of how much money they printed and put into this economy, I mean, that's a lot of debt we just added. And if you could charge yourself, the interest rate on the credit card you just ran up, what would you what interest rate would you charge? As low as possible to get away with, right? So, I mean, I don't see it myself. But maybe I'm maybe I'm too bullish. I don't know, but I just don't see it at all.
It's hard to predict without a crystal ball anyway.
Well,
right?
and no one knows that, right? But I mean, as an investor, you've got to take your best educated guess, and go for it.
Yep.
So given that, I assume you're still actively pursuing deals and all that. Are you seeing? Because I know there's some syndicators I know are out there looking for deals and doing new deals, and others are just kind of waiting 3-6 months to see what passes. So I assume you're still. Are you finding the deals different, or because my thought was, and maybe this doesn't make any sense, but my thought was, if a deal was good in February and it's the same deal now, and it cash flows the same and everything is, why wouldn't you go after it?
Yeah, no, we're still active. We've got 3 deals going to contract, I think, next week. So we're very active. We got a newer deal in Texarkana. They're building the last 2 units for us before it close. So they're brand new. We're buying those at $100K a door. Our interest rate is like 3.5% locked in for 10 years on that deal. It's just amazing. They're getting $1,300 rents, and that's a mom and pop leasing it up. So we'll do better than that. And then, I mean, we've got this deal here in Cleveland, so I don't see it. And then like the Parkview Apartments deal that I talked about earlier, during COVID, it's March and April, I had probably 6 different groups out of New York City call me up and try to buy that deal unsolicited.
Wow.
So, I mean, and then a deal we looked at, we underwrote a deal in Plano, Texas. So our office is in Plano, north of Dallas, but it's a $25 million deal. That's the whisper price. The call for offers wasn't for another 30 days, but they already have 5 offers at 25 million or more to buy that asset. So there's not going to be a discount on units, in my opinion. Absolutely not. The only ones you're going to find a discount on. So there's a deal here in Cleveland. We're actually taking advantage of that, but it's a neighbor to one of our assets here in town. They're struggling. The ownership's out of Chicago. They should have stuck to A class. They bought a C class. Anyways, we're working with them now. It sounds like we're just going to walk in and take over their loan. And then, they just went out of the deal. So, but it's a rough deal. They had the wrong management company in there, and they're not used to dealing with C-class, residents on that and how to run those. So they're just tired of that. So those are the deals where you're going to see a discount, is where it was unstable pre-COVID-19 and they don't have any more money left to get through it, right? And those are pretty far and few between, because again, the lenders are typically willing to work with you. But I don't see a discount in pricing at all. If anything, it's going to go up because these interest rates are just insane, what you can lock in now.
Interesting. That's good to hear.
Yeah. I mean, we just got a quote on a term sheet on the 96 unit deal in Cleveland for 3.25% interest rate. I mean, it's just amazing. They're giving it away, guys. They're giving it away. So buy cash flowing assets with that and lock it in long term. You'll do very well.
Hey, Kenny, as investors, we subscribe to the know, like, and trust theory, but I also think that a large degree of what we look for are people that know what they're doing, obviously. Do you think in this market that, what are some things that we should be aware of as far as when syndicators are getting outside of their lane of comfortability with all the deals that are out there? If somebody's going to jump from being multifamily and all of a sudden they're going to go do something completely different, like how far outside of the lane is it when the red flags start going off, saying, okay, this guy's way too far out of his expertise, maybe we should pass on that next deal, if that makes sense?
I mean, so I get where you're coming from, because I'm one of those that they thought did that. So I was known as the multifamily guy for like 7-8 years. And then I started buying dollar stores, and people thought I lost my mind. Like, what is Kenny doing buying dollar stores? So that first fund, we actually only raised like $1.8 million, which is just not what I thought we'd be able to do. I thought it'd be much more than that. But anyways, the second fund, we pushed 3 million, so we about doubled it. But again, people were, initially like, what is Kenny doing buying dollar stores? So, I mean, you see that for sure. And then on the development side, so our first development was just me. I didn't take any investors in it. So I developed my own townhomes there across the street from one of our deals. Bought the lots myself, developed it, learned that business model first, and then I could point to that. So we were able to raise pretty good money on that development deal that we did in-house, or that we're doing 88 units on. So as long as they can build a team and know that asset, as long as they have got a good partner that is going to kind of take them the distance, then I think they can do it. You just got to make sure that they have the team built up around them. So I mean, a lot of folks will tell you just to stick to one thing, but Steve Jobs says you can. Said the company can do 4 or 5 things very well, and so we're sticking to 4 at Wolfe Investments. So we also do hard money lending. That's the 4th thing we do. I didn't think I talked about that, but we do hard money too.
Now, Kenny, you said Parkview Apartments. Obviously, that's in Columbus. Did you say you have another apartment community in Columbus?
Yeah, so Ponderosa Village, that's on the northeast side of town,
Okay.
off Ponderosa Drive.
Yeah.
And then we bought Forest View apartments as well. Both Forest View which is going to be rebranded here hopefully soon when the sign company gets to us on the list to Park Vista. But both Parkview and Forest View were fractured condo deals. So Parkview, there were 2 owners, one guy that owned 192 and an older couple that owned 24 units. So we bought those together on the same closing date. And then Forest View was only 88 units, but there were 5 different owners in that deal. So we had 5 different closings on the same day. But the value you create by owning the whole deal is massive. So if you're able to do that, that's a really good thing. And Fannie Mae typically doesn't do fractured condo deals unless you're buying 100% of the asset. So just keep that in mind. But that seemed to be what's kind of worked for us out of 2 out of 3 there in Columbus.
So one more question about like sponsors, kind of related to what Sean was asking, but a little bit different, I guess, is, we've, as a group, some of us, as Mike said, some of us have already done some deals, but a large portion of us are just trying to figure out how to get into passive investing. And so we're calling and talking to sponsors, scheduling the 30-minute or 15-minute call. And the know, like, and trust thing, it's hard to build that in one phone call. But do you have any, and especially since you work with Sumrock, so I assume you did some coaching and things like that. Do you have any sense of maybe some tips you can give us when we're talking to a sponsor to figure out if they're someone we should dig deeper on or think about investing with?
So what's funny is I've only had one person ask me for my background check, and it was on my first deal. But anyways, so I mean, I don't know, that's one thing people point to. I've only had that asked that once on the first deal. And she's still an investor today. But I always kind of joke with her about how she was the only one to ask for that. But that's one thing I guess I would, I don't know. People don't ask me about it, but I would, especially like if your goal is to just be a passive, you just want to probably talk to other passives and see what their experiences are with that sponsor on prior deals. And also ask them the tough questions as, did you have a deal go sideways? How did you fix it? Right. Because that's something that really a deal sponsor needs to be able to answer. Because I can tell you, I mean, we've had a few deals go sideways. And so we've had to step up and figure out how to get them back on track. Cause we all, as deal sponsors, we kind of show like a straight line on how this deal is going to go. I'd say probably 7 out of 10 actually do that. The rest of them do this. They track upwards, but they go up and down. It's an operations heavy business. So you need to ask them that kind of uncomfortable question is, what did you, did you have a deal go sideways? How'd you fix it? That kind of thing, for sure. Ask that. And then if your goal is to be, that's kind of one set of questions. And then, and there's a few others as well, I guess I'd ask, but the other ones, another way, so I started out as being a passive, fully knowing that I eventually wanted to be an active deal sponsor. And so if that's your goal, that's a few extra questions you got to ask. And so like, what we do, so I don't do any mentorship or coaching or anything like that. Our goal is to have $1 billion of assets under management by 2029. So I don't have time to mentor, But what we do is, and it's very informal, but for each deal, there's probably one or two people that I call active passives. I'm going to trademark that phrase, but what they do is they just let me know if they want to be that, kind of fit that role. And, I show them, if they're telling me that early enough, I tell them when we're doing due diligence, come walk units with us. They see the contract, the LOI. They already see the PPM because they're investing in the deal, but post close, whenever I'm visiting the property, they're more than welcome to tag along and check it out as well. So we kind of do that because that's what I did. And on both of our first passive deals, before I handed over that big check, I told them this is my investment and my education. So I wanted to, I'm here to invest, but I also want to learn. So if you don't want to ask, if you don't want to answer my questions, I'm not going to like really annoy you, but I'm going to ask a lot of questions, probably more than your typical passive. And they both took my check, and I learned so much because I asked them when they were going to be on site. I got to walk around, kind of see how they did their site visits, walk due diligence, all that kind of stuff. So we could kind of do that because that's what someone let me do. Two people let me do, and that really helped me get started. So we kind of pass on the torch that way as well.
That's neat. That's really cool.
Can one other question for you too? With a laundry list of investors like 1,100, several of us on the phone are not accredited yet. More of the sophisticated investors, as we're labeled.
Right.
What's your usage of individuals like that? I am one with your projects that you get involved in.
So we take sophisticated and accredited investors, there's one deal we just took accredited, and I'll never do that again. We did a 506C. It was just not worth it. So 30% of our investor database is sophisticated, and so we immediately orphan those people as well. And there's been two people that came up to me that we were one of many, but they thanked us for being part of getting them across that accredited mark. So that was a very good day when you get that call, right? So we take both. Yeah, we take both. And we also take cash or IRA or solo 401k money as well. So, and then that's a whole nother topic about why you probably shouldn't use your IRA for multifamily investing, but that's probably another hour-long call. Although I'm a guest on Quest IRA's conference coming up, so I can't say that too much. Don't share this, Jim.
No worries.
I think it has its place, but there's a lot of you're missing out on the depreciation, and that's just massive. That's a massive, to all this. I've legally not paid federal taxes in 6 years. Yeah. And we've had 7-figure revenue incomes, during that time, but it's all because of depreciation and what you're able to take. So if you're an IRA, you can't use that. You can't use that massive tool.
Yeah, I completely agree with that. When I first started in syndications, I started with the IRA money, and I invested in a few deals, and then quickly realized that the way to do it is be a private lender out of your IRA, right. Things like that. And then because you're such you said one of the 4 pillars is tax shield, and that's huge. I mean, you can't overstate how big the tax benefits are to doing it outside of your retirement. So I definitely agree with that.
Yeah.
Save that retirement for your financial advisor. Use the taxable money for the other.
You could guess what Jameson does for a living. Yeah.
Okay.
He's real estate friendly though. One of the few.
That's good. Yeah. So we have investors that want to, are new to, so I kind of tell them that, our hard money loans are probably better for IRA folks because they're not hit with the U-bit. But people do multifamily IRA stuff all the time. We have a lot of IRA investors, so kind of comfortable with.
If that's what you have, it's better than nothing, I suppose. It's better than putting it in the stock market, in my opinion. But we won't go down that road, Sean. Are there any other questions for Kenny? We're hitting about an hour.
I was just going to say, Kenny, I was already on your YouTube page and checking out some videos and stuff. So thanks for coming and sharing everything. And I'm going to, I'll be one of the views on some of those videos that you posted.
Absolutely. We keep on trying to make better ones and better ones. It's the one that where I said Dave Ramsey's wrong got the most views. It's pretty funny. So
I saw that one right away and I started laughing.
Yeah, I was hoping he would have me on. I could debate him. So anyway.
If that happens, please let us all know. I
Absolutely.
would like to see it.
Definitely.
Yeah, and then I don't know. I'm going to be in Columbus probably within the next 3 to 4 weeks for sure. So if y'all want to go see an asset or whatever, just let me know. So we can organize that if y'all want to.
Yeah, that'd be interesting. Jim, do you want to reach out to maybe?
Yeah. I'll send you an email, Kenny, and then maybe we can hook up and that would be awesome to take a tour with you.
Yeah, that'd be really interesting.
For part, I don't know, for some or part of our group. And then the other thing is I have your email, but for the rest of the group, I know that I'd like to have a one-on-one chat just about investing with you. So if there's other people on this call that want to do that, what's the best way to contact you?
Sure. Yeah. So the best way is to go to the website, so wolf-investments.com. And then from there, if you hit the big red subscribe button, it'll ask for your name and email, and then it'll prompt you for for either a phone call or a meeting. The meeting's got to be in our Plano office, so it's a long commute for most of y'all. But hey, I'm open for it. But anyway, so we've set that up, and then once we have that call, we'll get you on our investor portal.
Okay. And will that call be with you, or do you have an investor relations person?
No, you guys get me.
Oh,
I
good.
don't have that. You guys get me. We have a lot of folks at the office now. I think we're up to 6 on the investment side. They're in the office, but I still do the investor relations piece. I think that's important. And then I still do the underwriting as well. So although I do have a guy that does the first crack at the underwriting now, but
Nice.
but I definitely in both of those roles still, for sure.
All right. Awesome. Any last questions?
What's the best hot dog at Dirty Frank's? Go.
Oh God.
The T-Dog. I mean, everybody should say the T-Dog. That's my favorite.
What's the T-Dog? I haven't been there in years. What's the T-Dog?
It's like sriracha mustard kind of deal. So it's good. So.
All right.
Where are you staying up in Cleveland?
I'm staying at the 9. So I've got a pretty swanky hotel. They're going to be our developer. The guys who own this deal are going to be the developer on our Rockefeller deal here in Cleveland.
Awesome.
So I get a special rate. I'm not paying full rate for this. This is it's pretty pricey for me. So
That's awesome.
Yeah.
All right. Well, Kenny, this has been fantastic. We've had a few guest speakers, and I got to say this was the best. It was really, really good, I thought. Don't tell the other guys, but super informative and really appreciate it. And I know I'm going to be hitting that red button and scheduling a call, and I would be surprised if a couple others don't as well. So thank you again. And also I'll be following up with you about maybe seeing if you can get a few of us through for the walkthrough. Whenever you're in Columbus.
Absolutely, and I'll let you know. I'll probably know this week. I've my schedule here in the next 3-4 weeks to get back up here. So.
Okay, great. Well, thank you, Kenny, and thank you all for attending. And I will be sending out an email about our next meeting and what we're going to talk about. But I just want to everyone thank Kenny, and we'll chat with you all soon.
All right, nice to meet you.
You guys, Kenny.
Thanks guys.
Kenny. Thanks,
See ya.
Kenny.
Thank you.
See ya.
Take care.
Thanks.